The revelation that one of the world's largest hedge funds, Tiger Global, has for several years been using Cayman shells to anonymously short sell European companies has refocused attention on the continent's post-crisis short-selling regulations. I'm here with Sam Fleming, the FT's financial policy correspondent, to discuss what this could mean for short-selling regulation in Europe going forward. And so, Sam, we've seen this news, and I imagine this has had a bit of an impact on sort of regulators and people who've been looking at this closely. I mean, could you describe to us a little bit about what these rules were and how this might have been getting around them?
The short-selling regulation came through in 2012, and it came at a time of lots of tumult in the financial markets in Europe. There were short sellers hitting bank shares, there were short sellers also hitting the sovereign debt market. Greece particularly was in the firing line, as we all remember. And so the European Union brought in this short-selling regulation, which attempted to harmonise rules governing short-selling around the European Union, and in certain circumstances to give power to ESMA, the European Securities Regulator, to ban short-selling in certain limited circumstances, something which the UK subsequently unsuccessfully challenged in the European courts. Part of that regulation were rules requiring disclosure of short positions when they reach certain thresholds. The first threshold was a 0.2% holding in the company, a short position in the company, which required the short seller to disclose that to the regulator privately. 0.5% holding then triggers an overall public disclosure obligation.
Right, so we know that Tiger Global was avoiding actually disclosing its own name when it went over the 0.5% threshold. It used instead Cayman Island registered holding companies. I mean, that we know is not against the actual law. It's not illegal, but will that be construed as being against the spirit of how these rules were written?
Certainly, if you look at the regulation, there's nothing in it which says that you have to disclose a beneficial interest. So I think you're right that in terms of the letter of the law, it doesn't seem to be a violation. It clearly undermines the spirit of the regulation. The idea behind this disclosure was in order that people could see who was shorting a share and therefore understand the potential systemic implications that could stem from that. That's what the regulation says. If you actually only see that it's an anonymous company that no one really understands, and as the piece in this morning's paper describes, actually was slightly misleading in terms of where indeed these anonymous companies were domiciled, then it actually does seem to undermine the spirit of the rules, yes.
So, I mean, this looks like a little bit of a loophole. I mean, is it possible that European regulators sort of made a bit of a mistake here, didn't spot this?
Yeah, I've spoken to one of the legislators this morning at the time, Sharon Bowles, who was the chair of the Econ Committee, which is involved in this legislation in the European Parliament. And she said it may well have been an oversight relatively early on in the course of that Parliament's legislative programme, something that perhaps later in the programme they might have been more likely to spot. But it's certainly something I think that legislators now that they realise this loophole exists, will want to try and close up if they can.
I see. So we might actually see moves to close this loophole now.
Somehow or other, they may want to try and do that, yes.
Sam, thanks very much.